Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Mickey Fulp, the mercenary geologist. How are you today, Mickey?
I'm doing fine and well. And you, Tom?
I'm great. Great to have you back on the show. Going through some of your Twitter feed at Mercenary Geo, something you should maybe make a hashtag is market Covidicy. So why don't we start there and talk about the markets and how things have gotten pretty silly since March.
Yeah, so I can't take credit for Covidicy. That was the person that runs my Twitter feed invented that term, but we've done some tweeting about that and really in regard to some of the crazy market caps that are going on right now. Tesla is the most valued in terms of market cap auto company in the world, more than Toyota, even though it produced 357,000 cars last year, and Toyota produced 10.7 million. Apple has a market cap equal to the GDP of Mexico, which is the 15th largest economy in the world. So, and we preface those tweets by calling it market Covidicy. So, and really part of it is, I think, due to this whole virus panic fears. I call a spade a spade. I still call it the Wuhan flu. But anyway, so that's the market Covidicy hashtag.
So how do we see this market Covidicy translating for silver and gold? We've seen gold floating right around the 1800 level, and yet we're seeing almost all-time highs being set in the stock market as well. What do you see forward as the price for gold?
Well, I'm a gold bull. I don't think that, or I do not think, and I do not want gold to go up really high, really fast, because that's not how good markets behave. So I like what gold has done so far, which is kind of 2 steps forward, maybe 1 step back, or a step forward, a pause. So we keep building a higher and higher base. A couple of weeks ago, we were range bound, or let's say until the end of last week, we were basically range bound between 1700 and 1740 for a couple of weeks. And so we keep building these bases, which is a very good way for a bull market to progress. Still haven't got to 1800. Probably it's gone over 1800 in futures markets, but my board right now, KICO, minute by minute, came in at 1784 right now. So I think there's no doubt that at some point we'll go above 1800. I think it's likely at some point we go above 2000. I just don't expect that to happen very quickly. If it does, it means that something's gone wrong with either another geopolitical event, or the markets become risk off, and we've seen not a really V-shaped recovery since the markets bottomed on, I think, March 23rd, but certainly a very good recovery. NASDAQ has gone to new records above 10,000. S&P 500's about, as I do the math, maybe 5-6% off its all-time high. The Dow has lagged somewhat, but that's because of a couple of big companies that have dragged the Dow down, or not allowed it to progress as fast. I think it's down about 10%, maybe 11% on the year. Really, the reason I think that gold has performed well in a recovering stock market is the fact of all this monetary supply creation worldwide. And it's not just the U.S., it's worldwide. So we're just with a stroke of keyboards all over the place. We create money, quote money, and then countries basically use their central banks to buy back their own bonds and their own debt. So that's a vicious circle, which means eventually all these fiat currencies are going to fail. I can't tell you when that's going to happen. It's probably not in my lifetime, but those are inflationary events by creating more and more money.
So doing some research for this interview, Mickey, you were saying how you thought that living in a world with $2,000 gold would be bad. Could you explain to us a little bit more about that?
Well, yeah, and so that really looked into a short-term $2,000 gold price, where it basically goes exponential and spikes, and that implies what I just referred to, geopolitical events that are unsettling, economies that are collapsing. So far, the banksters have been able to put Band-Aid after Band-Aid on things that really started in 2007. We had the first round in the global economic crisis. So you really don't want gold to skyrocket, because that implies situations where people are not secure and they're not confident in the economy, and they flock to gold as a safe haven. And when you get suburban housewives buying numismatic coins off the television, that's really unsettling, and I personally don't want to see that happen.
So in your opinion, Mickey, what would be a good, let's say, time to see that price in gold?
$2,000? I don't know. I don't want to see it this year. Let's put it that way.
All right. So let's turn to a little bit of silver talk. I know you have some interesting things to say on why silver isn't necessarily as good as some of the silver bugs might think.
Yeah, well, silver's not money. Silver hasn't been money since the late 1960s, when it went out of coinage, and the last time I think you could actually exchange a silver note for actual silver was 1968, thereabouts, in the U.S. So it's no longer money. It's 60% used for industrial purposes. It does have some coinage attributes, but people, entities, not governments, make for the most part. Now governments do too, but lots of mines and other entities that create silver coins. Really, it is a metal because it's dominated by industrial uses. It really only acts as a precious metal. It follows gold in times of extreme financial distress. And if you look at the gold-silver ratio, right now it's actually it's the lowest it's been probably in about 3 months. Let me do the numbers right now. The gold-silver ratio as we speak is 98, and it's been quite a while since it's been this low. So you can look at it as silver has a lot of catching up to do, and perhaps it does, but generally what happens when silver price gets to $20, and if we do the math on that with a gold price of about 1780 right now, $20 would be a ratio, if I'm doing the math right in my head, maybe 85 or thereabouts. The historic gold-silver ratio, median and the mean, is about 55. So, and generally what happens every time that silver goes up to $20, here come the specs and the traders, and they trade it right down off of that. And that last happened in July of 2016. Silver averaged over a course of about a month $20, but couldn't hold it because you get all these stockpiles of silver that come flooding back into the market. So the one thing I am not is a silver bug, and if anybody want to read recent views in October of last year, I published a piece called "Are These Silver CEOs Insane or Just Buggy Brained?" And it was kind of hitting at some fairly well-known silver CEOs, a couple in particular that will get on the bully pulpit and predict $100 silver or $300 silver. And in one instance, the guy predicted $1,000 silver, and I don't know what kind of mind-altering substances he was using at the time when he did this interview, but that's ludicrous because you take even the median or the mean of silver, gold-silver ratio, say 56, 57, something like that, and back calculate a gold price on that, and you're looking at gold prices that can be well above $10,000, even at, let's say, $100 silver. You're looking at a gold silver ratio at 90, which is significantly lower than it is right now. That gives you a gold price of $9,000. So it doesn't make any sense. And if we were to have a gold price of $9,000 or $10,000, I think not only would you want to own a bunch of gold, but you probably want to have a bug out bag by the door and lots of gold and guns and gas and goods, and be prepared to live a survivalist lifestyle, in my opinion.
Seems like it would be a recipe for some unsettling times.
Absolutely. I hope we don't get there. But, if $300 silver at $1,000 silver is about as probable as when pigs fly, in my opinion.
Interesting. So, Mickey, as we think about gold rising and trying to time that market, explain to us a little bit about why you prefer explorers over miners.
Yeah, so let's first say you should never conflate owning gold with owning gold stocks. Got very little to do with each other than, in fact, when the price of gold's high or on a uptick, the gold stocks do much better. Number one, the margins for the miners become better. But the explorers, I don't like miners. If you look historically, since the beginning of the first run of gold in a bull market in 2003, the major mining companies and the mid-tier mining companies were unprofitable. And we've done pieces back in 2015, 2016, and we case studies where we showed that they were unprofitable. So mining is a really tough business, and not only that, but they've kind of followed a Wall Street style of capitalism, as I referred to it, where it's all about growth, it's all about revenues and the next quarterly report. So they're not really focused on building stable companies. I much prefer explorers because I think that's where you get the highest reward for the least amount of risk. Now, admittedly, they're very high risk stocks, but that's where you can get 2 baggers and 5 baggers and 10 baggers. And the history of my stock picking career, which now is into its 12th year, or actually, I guess I'm starting into my 13th year. We've hit on about a little bit more than 50% on every stock we picked, and a hit to us is a double in 12 months or less. So not just a bit of profit, but a double in a year. And that's the goal, and we've been quite successful at doing that.
So as a geologist, Mickey, what are some of the attributes that you're looking for, let's say in a jurisdiction, or something that makes these explorers more attractive to you?
Well, one of the things you got to pick, number one, is your geopolitical jurisdiction. So as I have evolved in my thinking and my stock picks over the years, I have become less tolerant of geopolitical risk. I want to find a project that is in a safe jurisdiction with rule of law and secure mineral tenure. So that said, we're looking for a project that has a chance to be a flagship project or is the flagship project. We like things that have permissive geological environments, so the right kind of deposit in the right area. One of the reasons I love Nevada, it's the best place to explore for gold in the world. Because you've got lots of gold mines. The best place to find a gold mine is next or near another gold mine. The best place to find a copper mine is someplace where there has been a history of copper mining. So those are a couple of things that we look at. We like big geological systems, meaning that there's been lots of hot waters, fluids, percolating through fractured and beaten up rocks over a significant period of geological time, which allows larger and higher grade deposits to be produced. We like to work near tectonic boundaries because those are fundamental flaws in Earth's crust. So we like working in areas that are prone to have earthquakes because those oftentimes catastrophic movements of rocks allows mineral-rich fluids to come from the depths in the earth.
That was actually something I had in my notes for a little bit later, but I was wondering what the significance of posting earthquake reports are on your Twitter feed.
Well, we just like geological events. So we post every earthquake worldwide through the USGS feed greater than 6.0, which is a significant earthquake, but there's hundreds of those every year. And those usually occur on tectonic boundaries, and well, they do, and those are areas that we often choose to work in or around. You know, I've personally been in areas, I guess, 3 times in my life now with nearby earthquakes that killed people greater than 7.0. One in Peru, one in Chile, and then another in downtown Los Angeles. That doesn't quite count, but I was working in Peru and Chile at the time. And actually, the LA earthquake, I was working oil fields up in Inglewood, California. But that was a long time ago when I was a schoolboy.
So getting back a little bit to Nevada and the U.S. as a whole, why has the U.S. become a better place to invest, in your opinion, and let's say since Trump's inauguration? And could this be in danger of changing with the coming election?
Well, it certainly has to do with Trump's election, and he came in and rolled back regulations, cut corporate taxes, forced federal bureaucrats, long-term so-called civil servants, to adopt can-do versus can't-do attitudes that we saw through 8 years of the Obama administration, just a pro-business, pro-development scenario. And as a result of that, you've seen lots of reactivated projects in the western U.S. and new projects spring up. And it's been quite good for U.S. jurisdictions. The difficulty could be if the Democrats were to be elected, not only in the presidency, but in the Senate and the House, we would go back to really anti-development, capitalistic policies that we were saddled with for 8 years from 2008 to 2016, and was not good in the United States. Now it's the best it's been in quite some time, and you see all these projects in the western U.S. where numbers of ounces of gold are being built into the multi-million ounces of gold, and companies spring up. Just look at the number of companies working in Nevada and Idaho and Arizona and Utah, some in New Mexico, and it's quite astounding that companies even start working again in Washington and Oregon now, certainly far east of the Cascades. The left coast remains the left coast, all the way from the border to Mexico to the southwestern British Columbia. This kind of left-wing socialist political attitudes, anti-development, I guess, is really what sticks in my craw.
So could we see that development and, let's say, mining friendliness be threatened by the election in November? Absolutely.
I think there's no doubt about it. The candidate that's running is not mentally astute at all times, to put it gently. He is a figurehead, and he will not be running the presidency. We don't know who will, but rest assured, as the Democrat Party in the U.S. Moves further and further to the left with a socialistic, anti-capitalistic agenda, that's not good for business. Took the Trump administration to get our corporate taxes rolled back to what our worldwide peers are at 20%. That's kind of the standard worldwide. And for years, our corporate tax rate was 35%, and that's anti-business.
Mickey, as we're talking about timing and making money in the markets, I went through a presentation you made earlier this year at VRIC, and it was about how to make money in a bear market. You were discussing kind of the cyclical nature of especially the gold market and some of the miners, let's say from early November to late February. Could you tell us a little bit more about that, please?
Yeah, there's a couple of things there. First of all, in bear markets, and we have made money in bear markets, it's not as easy, but we get more selective. So in bull markets, sometimes a high tide floats all boats, and so it's easy to pick stock. It's more difficult in bear markets, but we have this criteria. We want stocks that can double in 12 months or less from where we pick them. So it becomes a matter of picking them during their seasonal or phase lows. So most companies, the great majority of companies, in any given 52-week running period will have at least a double between their lows and their highs. So it's incumbent on me to pick those stocks and speculate in those stocks when they are unknown, unloved, unwanted, and undervalued. And that happens to every junior at some point during any running 52-week period. So that's what we try to do. And then the other thing I think you're referring to is the seasonality, not only of gold, but gold stocks. And we use the Toronto Venture Exchange Index as a proxy for that. But what happens especially in years where people have made money, they need tax losses to wipe out capital gains. And that applies on both sides of the border, Canada and the U.S., for speculators. The rules are a little different on each side of the border, but basically people start selling their dogs or things they bought at the highs, and they start selling those earlier and earlier, but sometime in the mid to late fall. And we've found by doing these seasonal trends for gold and for the Toronto Venture Exchange, and it's 18 plus year history now, that there are seasonal ways to play this. So we found out that sometime December 15th on average, stocks hit their lows. So when people are selling good stocks that they're underwater, that's when we buy. And you can buy them in December 15th, generally 2 or 3 days either side of that, and you flip them. Sometime you can flip them in early January as people come back to work, and we've generated 20, 30, 40, even 70% gains by doing that. Or you can hang on to them till right before PDAC in early March. So you can sell them in late February and have phenomenal incremental profits. Now, these generally aren't doubles, but they're a short-term trading methodology that we've developed through our massive Excel database. We have a spreadsheet that now comprises 83 sheets and has 291,000 data entries and something on the order of 750,000 derivatives on those. So we use the database of commodity prices and market metrics, indices, to allow us to play these sorts of seasonal trading patterns.
Wow, that sounds like a very involved spreadsheet.
It's tremendous, and it's been in development now 8 years. It is now at 46 megabytes, which means we cannot transmit it via email. It's transmitted only via secure internet connection. But I have untold tens of thousands of dollars into this, and we don't buy data. We scavenge free data, but I hire graduate students from New Mexico Tech, about 70 miles down the road from my farm, and they come in here as competent to expert in Excel, and they leave here when they graduate and go get real jobs as fluent in Excel, the program Microsoft Excel.
So just expanding upon a little bit about that way of trading, tell us a bit more about, let's say, the power of two, something your broker at Haywood advised you to do a long time ago.
Yeah, I got involved in the junior sector exclusively. I was a consulting geologist and spent the first part of my career working for major U.S. mining companies. And starting in about 1993, I worked exclusively for Canadian juniors, and I got a couple of finder's fees and ended up with junior stocks and needed a broker. So the brother of one of the companies, CEO of one of the companies that paid me a finder's fee, introduced me to his brother, who was a broker at Haywood, and he had this way of trading where he picked, as a contrarian, he picked unknown, unloved, unwanted, and undervalued stocks. He didn't say it quite that way, but the double was the goal, and the methodology of trading is when a stock doubled, you sell half and take all your money off the table. So you have zero cost basis, and you have preserved your capital. So you start with $10,000 and you sell half, you still got your $10,000. Now you got $10,000 on paper with a company that you're playing to the upside, and you take your preserved capital and you go and do it again. So if you do it twice, you double your position. You do it 3 times, you triple your position. You do it 4 times, you quadruple your position in stocks, the value of those, and you preserved your capital where you can do it again. And that's evolved into something I call the power of two, and trading philosophy we still use, and it basically demands that as a contrarian, you buy stocks when they're at their lows during a 52-week period, and you flip them when they double.
Some really sound advice there, Mickey. As we wrap up, is there anything else you'd like to mention?
Well, I think going a little bit further into that, it's kind of a program methodology of trading, and it takes all the emotion out of it, and you should, as a trader, as a speculator, and notice I keep saying a speculator. We're not investors. We speculate in these stocks. These are not investments, so you've got to trade them. And you want to trade always without emotion. And the markets are driven by three emotions, and they're not good. One of them is greed, one of them's fear, and one of them's panic. So three emotions. And fear is in the middle of this because people get greedy in bull markets and they think they're going to hold on till they get that 10-bagger or something, and they fear missing the next big thing. So because of greed, they fear that they're going to miss out, and they make unreasonable decisions that come back to bite them. When stocks start going down, then here comes more fear and the panic. So the fear generates a panic that you can't get out soon enough. So you go in and sell everything. You throw the baby out with the bathwater, and we saw that in late March when the markets cratered, and a couple of well-known newsletter writers sold everything, or sold half of everything. We're getting out, the market's going to hell. And what happened 2 weeks later when we had that little bit of V-shaped recovery? They go back in and buy the same stocks at more money than sold them for. I mean, so the point being that you must trade without emotion. And that's what we try to do. And this trading methodology allows you, if you follow it, allows you to trade purely on stock prices and purely on a program that has worked time and time in bull, bear, and neutral markets now for me for 27 years.
That's some sound trading advice there, Mickey. Maybe just mention where we can find more of your information.
Yep, mercenarygeologist.com. We run a sponsor model, so we offer a free subscription service. And I haven't checked the numbers, but we're up to about 8,500 subscribers. The advantage of becoming a subscriber is you get my stock picks, which are restricted to free email subscribers only. So you just go to my website, mercenarygeologist.com. There's a mug shot, and below the mug shot is a banner that says free subscription. Click here and sign up. You got to give us a name and email address. You can fake your name, but you got to give us a working email address, and you'll get something from us every Sunday, and you will get my stock picks immediately when they come out. And then finally, we have a very active Twitter feed, which you referred to when we started this. It's @mercenarygeo, and we have 51,100 followers. We have a lot of fun with that, not only with stocks and ideas, macroeconomics. I'm a hardcore, good old boy American hillbilly redneck libertarian, so we do that sort of stuff and talk about my sports teams. And I've been fishing a lot during this whole virus epidemic, so you'll see a few fishing pictures there. And we've been doing quite well on the Rio Grande for catfish lately.
Excellent. Well, best of luck with your fishing, and thanks for your time today, Mickey.
All right. Thanks a lot, Tom. I've enjoyed talking to you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?